Good morning, everyone. I'm Roy Güllüoğlu. Welcome to Market Update featuring by Market Sol and Rationale. The markets have been experiencing huge sell-off since the reciprocal tariff announcement, and like the uncertainty is still there. We saw like a huge sell-off in indices. It's also in like precious metals as a first reaction. Some flow we saw in like bonds. As a safe haven, and like with some like inflation expectations or Tame debits. I'll come into details about that. In today's video, I would like to go through some. I would like to go through the previous crisis that the market has experienced, like a 2008, 2020 COVID crisis, through the analysis of great, like it was a great article that I've read this week, the NYU professor Aswath Damodaran's analysis. I'll try to show you from that analysis that how any kind of like a crisis after the crisis happens, how the markets react, what are the steps, and that kind of what should we expect next. I think that's really a nice summarized guide. And yeah, first I'll show you that evaluation. After that, I will skip to few like a major charts in order to show you the impact of recent developments on those charts and what to expect next. Okay, let's start. First of all, here, as you can see, this is like I got this table from the article of Aswath Damodaran. It's showing the effect of the crisis on markets, and like a step by step. So first of all, as you can see here, there should be a trigger event, an economic or political or financial event that triggers the financial crisis. Then we see the initial reaction from the market where like investors have only one tool to react. Whatever instrument they have, they can react with that instrument. So that's why investors respond by changing the only thing that they can control, the pricing. Then the second step is the aftershocks. Like after this, after we see the initial reaction of the market on prices, there might be a trigger event that the impact of that crisis is not that short dated. You know, there should be some like related. Let's say like a kind of like a train impact. You know, there's some after that it has something that is affecting, and that might lead to deepen the sell-offs. That's the aftershocks part. And the third step is the real effects on short term, and the fourth is the real effects on long term. In the near term, the economy is affected by negatively for sure. Due to like a real growth declining, we might see some depreciation, like earnings for like a short-term earnings, or in the like also recession indicators, pushing that okay, recession is there, real economy is like weakening, and that's the short-term effect. And long-term effect is like the inflation. For example, why do markets give so much importance on 10-year 10-year interest rate? Because it gives some hints on long-term economic growth and long-term inflation expectations. So that's why the long-term real effects on inflation is pretty important, because if we see an increase in inflation expectation, we will see an increase in 10-year yields, which will lead, rates are the main source that are leading to general market prices. That's why there will be that kind of impact. So when we come to the details, how this short-term impacts might how exactly they can impact the market. First of all, base year, for example, it happens in 2025. And this base year 2025 earnings will be impacted. That will be the first impact. Then on the long term side, as you can see here, expected earnings growth in the next 5 years will be impacted. And with that, with the like earnings expectations coming down, the expected cash flow, this formula, like it's kind of a DCF model actually, and through there, as you can see, with the long-term effects, the stock prices fall because of the concerns like a risk of sentiment, and then treasury rates fall, as also like now I'll show you what happens. I mean, I'll try to explain what happened in this in 2008 2020. First of all, in 2008 banking crisis, for example, as a trigger event, we saw that like the collapse of Lehman Brothers, for sure. Then the market reacted between like September 2008 and like September 15 to September 29 in 2008. The S&P 500 dropped by 11%, and 10-year treasury rates fell from 3.72 to 3.58. These numbers are like I got all these numbers from Professor Damodaran's article, and that was the market reaction. So we're in this step right now. That after, like here, Lehman Brothers, then market reacted, S&P 500 sell-off. Then the aftershocks is there were some rumors that more banking failures are on the way. So that was like a cash withdrawals continued. That's the aftershock that was expected. On the third phase, the economy entered a recession in the last quarter of 2008. The unemployment and inflation deepened. And fourth step was the economic growth continued to be continued to decline, and the like almost up until 2011, unemployment stayed high, and like a consumer confidence stayed low, and like more importantly, like the trust on institutions was gone. That was the long-term effect. So that was the anatomy of 2008 crisis. So when you go to the details in the like a short-term effect, S&P 500 earnings dropped by 40% in 2008. That base year earnings, that's what I'm trying to say. It's in the near term what happens for that year, for 2008, the base year earnings got down, and as a long-term impact, when you come to the year, what happened in 2008, earnings couldn't recover to the 2007 like prior crisis levels until 2012, and then we saw that treasury yields from 3.72 to 2% level, and stock prices fell almost like 30%. So yeah, that was the anatomy. Like that was the how it worked, how it happened in 2008. When we come to the COVID crisis, for example, the trigger event for sure was the discovery of COVID crisis. Then the market reacts between February 14, like the February and March 2020. There was a huge sell-off, and as an aftershocks that as the pandemic took hold, like businesses were shut down, and the expectation was, okay, that will take much more time to reopening the markets, the real economy, and we all stuck at our homes and stuff. That was the aftershock for sure. The real effects on the near term was in COVID crisis, the economy entered the recession, and unemployment exceeded like a 20%, and that like a long term, when you come to the real effects, like a long term effect, actually with the government payouts, and there was a huge support from a rate side, the economy recovered fastly actually compared to 2008. And when you look at details, for example, S&P 500 for the base year earnings for 2020, earnings dropped in 2020 second quarter. It wasn't that a long lasted, because there was a huge support from the Fed and government side, and because in 2008 kind of they had their lessons, and I mean the details are so different for sure in both crises, but at least you can resemble some issues, at least some steps are so similar. And when we come to the 2025, let's say, tariff crisis, what happens? The trigger impact for sure, the announcement of Trump tariff on like a 2nd of April. The market reacted again this second step, and S&P 500 dropped like an almost like a 9%. The aftershock impact, I think we're currently in this phase right now. The tariffs for sure will create some, due to like reciprocal impact, the other countries will respond to this, right? And the way that they will respond is still uncertain. That will be the aftershock probably. That's why this first sell-off, but we need to monitor if the aggressiveness of countries will stay this level or will come down. We need to monitor it, and I'll talk about this about like what's the goal of US on all these story. I think that will be a nice insight in order to monitor how the other countries will react to this. So the short-term real impact, we need to see how much will earnings drops for 2025, collective earnings in most recent 12 months. But for sure we can say that the likelihood of recession has increased with all this uncertainty, and and like the long-term impact on the real economy, the like a barrier on global trade will reduce the long-term economic growth, and it might lead to higher inflation maybe, because tariffs might have two impacts. One side is for sure the price is going to go up, okay, it's going to go up maybe, but that price go up at the same time creates some I mean, not only the exporter country will be carrying all the cost coming from tariffs, right? Also the importer companies will be getting, also like the last customer will also get some part of it. So that margin occurring by like generated by tariffs will be shared through the agents of that trade. So in that scenario, the profit margin will come down, and that, apart from inflation, that might also put some pressure on economic growth side. So growth and inflation side is also unknown, but we also saw that with the risk-off sentiment, we saw that there was a huge demand on bonds, and rates came down, and we need to monitor that right now the equity risk premium in order to see the impact on, because as long as the risk uncertainty is high, investors seeking for more risk premium, that means that they want to buy the equities back from lower prices in order to have a more premium. That's the mentality. But I think the most important part here, we need to monitor how will other countries will react, if whether this aggressiveness will pursue or not. And that's I think it was a great article. If you Google his name, you can find through his website, you can reach the whole article. That was so informative. And apart from this, I would like to talk about a bit the what's the goal of US for this tweet. This post from President Trump came in just a few hours before that I'm recording this video. So I think for sure all you know that the major goal is they're targeting China for sure. Like this Republican government's main target for sure is their target is China in terms of a trade and economically. But what's the difference than the first presidential time of Mr. Trump's and the current current presidential time. What's the difference? The difference is back in that time the tariffs were implied on only to China, and as a solution Chinese companies had established some companies in some other let's say Little Asia countries like Bangladesh, Vietnam, and those kind of in those kind of countries. They had established a lot of manufacturing facilities and stuff, and they had done their export to US through those companies, through those countries. But this time US knew this, and that's why, as you all follow that, all reciprocal tariffs that were targeting also not only China but also some other Little Asia countries. That's why we saw the biggest sell-off in their stock markets, for example. I think here the since the main while their main goal is targeting China, but they know that tariffs might lead to some inflation for sure. But in the inflation of United States, the oil prices are pretty important though. That's why he's when he says and also for sure economic growth is at least unemployment, labor side is so important in order in the political side. That's why he's emphasizing in this tweet just all this a market sell-off happened. First of all, as you can see, he's emphasizing China's doing really bad in the recent after the recent developments in the stock market. Plus, as you can see here, interest rates are down. I'll come to that. And oil prices are down. As you can see, he's emphasizing especially those sides that means inflation will not be that high. Interest rates are down. Labor growth, unemployment side will be good. Don't worry. Food prices, that's another important side on the inflation, and politically really important. No inflation. As you can see, he's emphasizing that side. That's why while they're trying to controlling inflation through these sides, and amid the situation this year, $9 trillion the US government will need to pay back refinance their debt. They need to put pool rates down. That's why also President Trump is kind of pushing Fed to cut rates. So definitely I think we have to face that all this a tariffs issue plus all this a general picture suggests that. So the market was expecting 2 rate cuts for this year, but I think that will be much higher than expected. And what I expect for the equity side, at some point, for the risky assets, at some point market will be pricing that rate cuts will be much higher than the expected, and that will lead to some a rally back until the end of this year. That's my expectation. So still my base scenario, maybe you can question the soft landing side as the a recession risks has increased, but the main scenario is, I think, as long as the oil prices will hold just around a $60 level, and just below $60, technically, let me switch to that side quickly. When you go to the oil chart, for example, here, I had shown you before actually. This is a weekly chart. As you can see, after this let's say 59, 60, that range, below that level, nothing to hold it, right? And I don't think that oil prices OPEC plus actually is kind of that's where United States have huge impact on it, and that's how they're holding oil price low, and that's how they're controlling the inflation. That's the first side. So let me go quickly how all these pictures. So let me just wrap up. The target is China in terms of trades, and they had a solution to do all this trade through Little Asia countries. That's why these reciprocal tariffs targeted them also, not only China but also those other countries like Bangladesh and Vietnam, etc. and and like that's, I mean, that's the way through OPEC. They're just like increasing the supply of oil. They're taking the oil price under control. Thus, they're controlling the inflation. With the risk-off sentiment that is arised, rates are coming down, and he needs some support from Fed to cut rates. And this recessionist environment will also give some support to give some room Fed to rate cuts. But inflation side, that will be a difficult part. Inflation, with only controlling the oil, will they be able to control the inflation? That's the problematic part. And the $9 trillion refinancing issue, they need to refinance this with lower rates. That's why they need lower rates. So just as a result, I expect that the oil prices will be in control around like at these levels, as you can see. Plus, rates are going to come more than expected. That's why any kind of correction in like a correction, or I don't know, huge sell-off in like a risky asset might provide some buying opportunity. That's, and also for the gold, I'll come right now. As the rate's gonna come down, still there's upside room for the gold. That's how I can summarize my current perspective on market. So US 10-year yields, as you can see, so this is the weekly chart from September until January. This was the period that Trump's victory win phase, and higher inflation was expected due to expected tariffs. And at that time, the market was only focusing that tariffs will create some inflation. That was the main mentality. That's why 10-year yields went up. Then after tariffs slowly got certain and uncertainty kicks in, the investors flew to like a more like a riskless asset and like a safe haven, like UST bonds, and we saw that yields came down. And same actually here happened in dollar index. There's only one difference here. The European side, this fiscal the German government fiscal expansion also pushed euro higher. That was only another support in this like a decline. There's also support from that side. When you come to oil, as I mentioned, like I'm not coming here again. And as you can see, what happened here in the gold. Let me show you in this daily chart. As you can see, the only phase that gold has like a sideways movement is the part that Trump win phase and higher inflation expectations due to tariffs. Because why? When the inflation expectations going high, the real rate goes up. When the real rate goes up, gold generally consolidate or like do sideways movement or comes down, because I mean, there is like a better like a yield there. Why should I go to gold mentality? But then it resumed its upward movement after tariffs slowly got certain and the uncertainty kicks in. That's the mentality. On the Bitcoin side, I didn't tag it with the arrows that I mentioned, but it's actually this phase. But what you see in the other charts a bit different here, because Trump administration have they have some different impact on Bitcoin, as they're like a pro crypto. That's why this the expectation on crypto, there was a huge enthusiasm were here. But after the tariff uncertainty kicks in, as you can see, sell-off also occurred in Bitcoin as well. For Bitcoin specific, let me say a few words technically as well. I had mentioned this actually, but here I think between 88 and 77 levels, it's consolidating here. I think it's time to sit and wait patiently, not to I mean, you can do like a range trading between these two bonds, these two line, but apart from that, as long as we don't see some at least some after consolidation here, I mean I expect a little bit more consolidation here. Why? When you come to the weekly chart, as you can see, actually I had tweeted about this as well. since the beginning of this like trend, as you can see, all this like consolidation, move up, consolidation, move up, and I think that's what is establishing in this area. That's why, as you can see, we need to see some like consolidation like this, also some squeeze like. And while this happening, if we see some low volume condition, that will be amazing. As you can see, this breakout occurred after this low volume. As you can see, these green bars are like a high like showing high volume. It's a pocket pivot actually. And after this low volume, when we see high volume breakout, that will be the trigger to come back in. That's all I'm gonna talk about this week. Each video I say that, okay, I'll cut short this time, but yeah, there's always something to tell more. Thank you for watching. I wish you find whatever you see insightful, and I wish you a great week. Have a good one. Bye.